This tiny country in Southeast Asia with a population of 5.9 million people is experiencing a very unusual immigration trend from the rest of the world. Right now, across the US, Europe, and even in countries like Japan and Australia, you're seeing anti-immigration sentiment and protests everywhere. These are often driven by working-class citizens who associate the word immigrant with poor or undocumented workers who they fear will take their jobs away, drive up housing prices, and strain public services. But in Singapore, the story is completely flipped. The so-called immigrants are the ultra-rich. To be fair, this isn't a brand new phenomenon. Some of the world's wealthiest people have been planting their flags in Singapore for over a decade. Back in 2009, Eduardo Severin, whom you might recognize as the Facebook co-founder portrayed in The Social Network,
Wired in. Is he? Yes.
renounced his US citizenship and made Singapore his permanent home. In 2019, James Dyson, the British vacuum tycoon, moved his company's headquarters to Singapore and bought the country's most expensive penthouse for $54 million. But what used to be a handful of headline-grabbing billionaires has now become a full-on wave. In 2024 alone, about 47 billionaires and more than 3,400 millionaires moved to Singapore. And as of 2025, Singapore is home to 49 billionaires out of the roughly 3,000 billionaires worldwide. The total number of millionaires even more staggering, over 240,000 as of 2025. Now, just to put that in perspective, Singapore has just 5.9 million people, yet its share of global billionaires is about 22 times higher than its share of the world's population. At this point, you might be wondering, why would that even be a problem? Like, if wealthy people bring their money into a country, isn't that a good thing? Well, it depends on just how much wealth we're talking about. Just in 2024 alone, these new billionaires and millionaires brought with them an estimated $150 billion in wealth. For a city-state of 5.9 million people, that's an economic tidal wave, equivalent to almost 1/3 of Singapore's entire GDP arriving in a single year. So when a single year of immigration brings in wealth equal to almost 1/3 of your entire GDP, it's hard to see that as luck or accident. The real question is, how did they do this? And what does it mean for ordinary Singaporeans now living in a country increasingly shaped by billionaires? Let's break it down. Starting with one of the main drivers of Singapore's wealth boom that most people outside finance have never heard of, the family office. First, it's important to note that starting a family office is actually one of the 3 ways the ultra-wealthy can qualify for permanent residency in Singapore under what's called the Global Investor Program. What's interesting about this program is that it's highly exclusive. Singapore only approves a few hundred a year, which makes it feel more like a private club than a typical visa scheme. So let's take a look at 3 options. Option A is to invest at least 10 million Singaporean dollars, about $7.5 into a new or existing Singapore business. And it can't just be a shell. That business has to employ at least 30 people, and at least half of them must be Singaporean citizens. Option B is to put down 25 million Singaporean dollars, roughly about 18 million dollars, into a fund approved by the Economic Development Board, which then invests in Singapore-based companies. And then there's option C, the family office route. To qualify, you need to set up a single family office in Singapore with at least 200 million Singaporean dollars, around 150 million dollars, in assets under management. Out of that, at least 50 million Singaporean dollars, or about 37 million dollars, has to be actively deployed into qualifying investments. On top of that, you're required to hire at least 5 professionals locally, with 3 of them being Singaporean citizens by the 5th year. It just so happens that this family office option has become especially popular with billionaires in recent years. Today, Singapore is among the top global hubs for family offices, surpassing even Hong Kong and rivaling Switzerland. So what exactly is a family office? Think of it as a private investment firm, but only works for one family. Instead of just keeping money in a bank, the family appoints a professional manager, often former banker, lawyer, or hedge fund investor, to create a separate legal structure that acts like their financial headquarters. This separate legal entity doesn't even need to carry the family's name. Most of them use neutral names, so unless you're told, you would never know which billionaires it belongs to. From there, the family office manages investments, hires staff, sets up trusts, and even plans how wealth will be passed down to future generations. Now, what kind of returns they make is not publicly available, since they don't have to report earnings like hedge funds or investment funds. But from our research, they're not chasing risky bets. The goal here is to preserve wealth for the next generation. So why do billionaires love family offices? Privacy, for one. Unlike hedge funds or VCs, they don't have to disclose performance publicly because they only manage their own money. Second, tax advantages. Singapore's government has made it even more attractive with tax exemptions. As long as the family office hires locals and reinvests domestically, it pays little or no tax on its investment gains. Okay, so family offices help explain how billionaires are incentivized to move to Singapore, but that still leaves a bigger question. Why Singapore? After all, there are plenty of other financial hubs in the world: Hong Kong, Dubai, Switzerland. So why has Singapore pulled so far ahead, especially in the last few years? On the surface, the advantages look pretty straightforward, and I'll start with a few obvious points. Singapore is politically stable. Since independence in 1965, the country has been governed by the same party, the People's Action Party, founded by the legendary Lee Kuan Yew. Political protests are rare, elections are orderly, and the government famously plans policies decades in advance. For billionaires, that kind of long-term stability and predictability matters. They know Singapore isn't suddenly going to change tax laws or shut down industries the way many other countries do. Language and safety also plays a huge role. English is Singapore's official working language, written into law, taught in schools, and used in courts and business. And when it comes to personal safety, Singapore routinely ranks in the global top 3 in surveys by Gallup. Violent crimes are rare, and penalties for drug trafficking and violent offenses are notoriously harsh. What about corruption? Every year, Transparency International ranks countries by perceived corruption. Singapore consistently lands in the global top 5, tied with countries like Denmark and Finland, and ahead of the US and UK. Its Corrupt Practices Investigation Bureau has the power to arrest anyone, including tycoons, officials, and even ministers.
Even a minister can get caught and charged? Of course. In Singapore, no one is above the law, no matter who you are. As long as you receive a benefit in return for a favor, you will kena.
Punishments are severe: mandatory jail time, huge fines, and career destruction. This zero-tolerance policy on corruption has become a core national value. And for families, there's another big draw: a world-class healthcare system and some of Asia's most competitive international schools. Singapore's own universities, like NUS and NTU, consistently rank among the global top 20 in science, business, and engineering. All of this is the product of deliberate design. Lee Kuan Yew's blueprint for Singapore was built on meritocracy, zero tolerance for corruption, and heavy investment in what you might call soft power infrastructure: education, law, and public safety. Everything was about creating a country where global elites would feel safe parking their families and fortunes. And then there's the financial cherry on top. Singapore has no capital gains tax. That means if a billionaire sells stock, property, or even an entire company, every cent of profit stays with them. There is no inheritance or estate tax either. In the United States, the estate tax can take up to 40% of a fortune when it's passed down. In Europe, inheritance taxes are often 20 to 30%. In Singapore, families can pass down dynasties worth billions without losing nearly half to the government. Corporate tax is also capped at a flat 17%, one of the lowest among developed economies. With government incentives in finance, tech, and green industries, the effective rate can be even lower. Put together, the message is clear. Singapore isn't just a safe place to live. It's the most tax-efficient vault in the world for your family's wealth. But those generic advantages alone don't fully explain why so much wealth has flooded into Singapore so quickly in recent years. For decades, Hong Kong was the undisputed financial hub of Asia. Chinese billionaires raised capital there, bought property, and based their fortunes in the city protected by semi-autonomous status and rule of law under the one country, two systems framework. But all that changed dramatically after the 2019 mass protests and Beijing's response, the sweeping imposition of the national security law in 2020. This law instantly transformed Hong Kong's political and legal landscape. It criminalized broadly defined acts like subversion, secession, terrorism, and collusion with foreign forces. For business elites, this was especially chilling. The law gave authorities greater surveillance powers, allowed mainland security agencies to operate openly in the city, and created sweeping authority to freeze assets or detain people for vaguely worded offenses, sometimes for actions taken years, even decades earlier. Even deals that looked apolitical, like routine business with Western partners, could suddenly draw unwanted attention. From Beijing's perspective, the national security law was a necessary step. They said it would restore order after months of protests, defend China's sovereignty, and protect Hong Kong's role as a financial hub. But for wealthy families, especially those with international ties, the calculus completely changed. Their so-called safe haven no longer felt safe. Suddenly, even trusted institutions in Hong Kong had to juggle mainland and local rules, which meant less privacy and less predictability. Take Xiao Jinhua. He wasn't just any billionaire. He was known as the banker to the princelings, managing fortunes for some of China's most powerful political families. He built Tomorrow Group, a financial empire worth hundreds of billions. In 2017, Xiao was literally abducted from his room at the Four Seasons Hotel in Hong Kong and taken back to the mainland. For years, no one knew where he was. Then in 2022, Beijing announced he had been sentenced to 13 years for bribery and stock manipulation. The message couldn't have been clearer. If someone like Xiao with that much money and political connection could vanish, then no billionaire was truly safe. At the same time, Beijing was launching a sweeping campaign against its own billionaire class, especially the tech industry. The most famous case was Jack Ma, the founder of Alibaba. Just weeks before his Ant Group was about to stage the world's largest IPO, Ma gave a speech in Shanghai. In it, he accused Chinese regulators and state banks of having a pawn shop mentality, basically saying they were too conservative, too outdated, and holding back innovation.
中国不是金融系统性风险，因为中国金融基本上没有系统，但是我们现在管的能力越来越强，好的创新不怕监管，但是怕昨天的方式去监管。银行喜欢给好企业、不需要钱的企业贷款，拼命的贷款，结果让很多好企业变成了坏企业。今天的银行延续的还是当铺思想，抵押的当铺思想是不可能来支持未来30年世界发展对金融的需求的。
That was seen as crossing a line. Within days, Ant Group's record-breaking IPO was abruptly pulled. Ma vanished from public view for months. Ant Group itself was forced to restructure under much tighter financial regulations, killing its ambition to become a global fintech giant. And it didn't stop with Ma. Other tech giants like Tencent suddenly found themselves hit with massive antitrust investigations, multi-billion-dollar fines, and in some cases, forced breakups. China's leadership defended these moves as necessary for curbing monopolies, reducing financial risks, and promoting what they call common prosperity. The official line was that extreme wealth needed to be reined in to ease public resentment against tech tycoons and keep society stable. But from the perspective of global investors and Chinese billionaires, the message was clear. If you looked like you're challenging a party, or even if you're simply too successful, too independent, or too visible, your fortune and even your personal freedom could be at risk overnight. That's why, starting in 2020, Chinese and Hong Kong billionaires began voting with their feet and their money. They started moving themselves, their families, and their capital out of China. But where do you go if you're a Chinese billionaire? The US feels risky because of political tensions. Dubai has appeal, but its legal system isn't as transparent. Singapore, on the other hand, is nearby, politically neutral, and above all, safe. And the numbers tell the story. According to the Henley and Partners report, nearly 10,000 high net worth individuals left China in 2022 alone, the largest wealth migration in the world that year. But it's not just the Chinese. For wealthy families in Indonesia, the Philippines, and Thailand, the biggest risk isn't taxes, it's politics. The governments can change quickly, regulations shift without warning, and the rule of law remains uneven. Parking money in Singapore is like buying an insurance policy against all of that. On top of that, its transparent financial sector and open pathways for family offices turned it into Asia's new wealth hub almost overnight. So this might sound like a golden age for Singapore, but for ordinary Singaporeans, it's a very different story. What happens when billions of dollars of foreign wealth collide with a city of just 5.9 million people? That's what we need to explore next. Just to be fair, not everything that's happening in Singapore right now is because of billionaire migration. The world has changed a lot in recent years, and Singapore is dealing with the same global forces as everyone else. That being said, let's start with what's clearly working. This influx of billionaires and their money has created an economic boom that's hard to ignore. The financial sector alone now manages over 6 trillion Singaporean dollars in assets. That's created tens of thousands of jobs for locals, from entry-level analysts to senior portfolio managers. Singapore has become the wealth management capital of Asia. Tax revenue has also surged. Even without income taxes on the wealthy, the government collects massive amount of VAT, or goods and services tax called GST, on luxury spending, property taxes on expensive real estate, and corporate taxes from all these new businesses. This money funds everything from public transportation to healthcare to education. These billionaires are also investing heavily in Singapore's startup ecosystem. They're funding local tech companies, backing new innovations, and helping Singapore transition to a knowledge-based economy. So yes, there are clear upsides. But now, let's talk about the challenges. Housing costs have definitely gone up, and it's important to understand that Singapore isn't unique here. We've seen housing prices explode in cities around the world, from London to Hong Kong to New York. But here is where Singapore is different. The backbone of the entire housing system here is public housing, known as Housing and Development Board, or HDB flats. And unlike in many countries, public housing in Singapore isn't something people look down on. More than 80% of Singaporeans live in these government-built apartments. They're clean, well-managed, and affordable by design. Owning an HDB flat is considered normal, even middle class or aspirational. Here is the problem. Even HDB prices have shot through the roof. In 2022, resale flat prices hit record highs, and the once rare phenomenon of million-dollar HDBs became almost routine. In fact, in just one quarter, Over 400 public flats sold for more than $1 million Singaporean dollars. For what's supposed to be public housing, that's a huge red flag. It's not that every billionaire is directly outbidding a Singaporean family for an HDB flat, but when the ultra-rich pushes up the top, it ripples down. Private home prices rise, developers raise expectations, and even public resale values climb. Suddenly, a young couple trying to buy their first HDB flat feels priced out of their own city. And it doesn't stop at housing. In 2023, Singapore was ranked the world's most expensive city. Groceries, transport, eating out, it all adds up. Of course, some of this is global inflation. Some of it is simply Singapore's small size and import dependence. But when more ultra-rich residents arrive, they also push up demand for high-end services, and that trickles down into everyday life. What we do know is that real wage growth for ordinary workers was just 0.4% in 2023, while costs kept rising. That squeeze is real, even if the causes are complex. The result? Inequality that's becoming impossible to ignore. Singapore now has the worst wealth inequality in all of Asia Pacific. While Singapore has over 240,000 millionaires, about 800,000 adults have less than $13,500 in total net worth. The top 10% of households control 2/3 of the country's wealth, and the contrast is more visible than ever. On one side, gated mansions, international schools, private clubs. On the other, ordinary Singaporeans worrying about whether their kids will ever own a home. But what's more directly connected to the wealth migration is the social and cultural impact. You see, Singapore is a small country with a strong national identity built around shared sacrifice and meritocracy. But the sudden influx of global elites can change the character of neighborhoods and communities, and it can feel alienating. And that sense of alienation, more than just the high prices, is what can really eat away at national identity. There's a visible shift towards catering to global elites rather than locals. New restaurants, clubs, and services target international tastes and budgets. Some Singaporeans feel like they're becoming strangers in their own neighborhoods. The Singaporean government, of course, is very aware of these pressures. They raised property stamp duties on foreigners to cool the market. In 2023, foreigners buying property faced an additional 60% tax. They've also tightened family office requirements, raising the minimum investment threshold to try to slow the flood of money. But critics argue it's too little too late. For middle-class Singaporeans, those measures haven't made homes any cheaper or life any more affordable. So while Singapore is attracting unprecedented wealth, the reality on the ground is far more complicated. For the average citizen, it means higher housing costs, higher living expenses, and a growing sense that a country's prosperity isn't being shared equally. Which raises the fundamental question: how long can Singapore sustain this model without losing its national identity? Will it suffer a similar fate to Switzerland? That's what we need to explore next. Here is the uncomfortable truth about financial safe havens. They can stop being safe very quickly. For over a century, Switzerland was the undisputed king of private banking. Swiss bank accounts were synonymous with secrecy and protection. Those famous numbered accounts, strict banking secrecy laws from 1934, Switzerland's political neutrality, it all made Switzerland the ultimate destination for the world's wealthy. But then everything changed. Starting in 2008, the United States began an all-out war on Swiss banking secrecy. The global financial crisis had created the perfect political storm for America to finally go after offshore wealth. Here's what happened. The 2008 financial crisis wasn't just about housing bubbles or subprime mortgages. It revealed that American taxpayers were losing over $100 billion a year to offshore tax evasion. Swiss banks, led by UBS, were at the center of this massive scheme. UBS is one of the world's largest and most prestigious Swiss banks with over $1.5 trillion in assets. And after buying the American brokerage firm Paine Webber in 2000, UBS was supposed to report American clients to the IRS and withhold taxes. Instead, they did the opposite. UBS bankers were literally smuggling diamonds in toothpaste tubes, coaching clients on how to lie to customs agents, and setting up sham companies to hide American money. The real breakthrough came from an insider when Bradley Birkenfeld, a former UBS banker, decided to blow the whistle in 2007.
And that was how much?
That was 19,000 clients and around 20 billion Swiss francs, which is about $19 billion.
Then came the 2008 financial meltdown. Lehman Brothers collapsed in September. The American economy was in freefall. American families were losing their homes while wealthy Americans were hiding billions in Swiss accounts to avoid paying taxes. That's political dynamite. Suddenly, Swiss banks became the perfect target. The Americans threatened to cut UBS off from the US financial system entirely.
Corporate news, federal prosecutors are investigating 150 Americans who may have used Swiss bank UBS to aid them in tax evasion.
In today's interconnected world, that's essentially a death sentence for any global bank. No access to US dollar clearing, no American customers, no business with American institutions. UBS would have been finished. Faced with extinction, UBS folded completely in February 2009. They paid $780 million in fines and handed over the names of 4,500 American clients. This was unprecedented. It directly violated Swiss banking secrecy laws that had been in place since 1934. The Swiss government initially tried to defend banking secrecy. In July 2009, Switzerland literally told UBS not to give the US any information. Did that stop the US? No. The US went after Wegelin, Switzerland's oldest private bank founded in 1741. When Wegelin tried to pick up UBS's American clients, the US authorities gave him an ultimatum. You have 3 weeks to sell this bank or face criminal indictment. In January 2013, the leftover part of Wegelin pleaded guilty to helping Americans hide $1.2 billion from the IRS and paid $57 million in fines. Then they announced they would cease to operate as a bank permanently. The US pressure broke the dam, and faced with being labeled a non-cooperative tax haven by the OECD, G20, as well as pressure from the EU, Switzerland had to sign automatic information exchange agreements with over 100 countries, meaning Swiss banks now had to share account data with foreign tax authorities. As a result, Swiss banking secrecy for foreign clients was essentially dead. It wasn't that Switzerland didn't push back, it's that American economic power was simply too overwhelming to resist. So the big question is, could the same thing happen to Singapore? The US technically could apply the same pressure to Singapore. In 2016, the US Department of Justice explicitly named Singapore as one of the jurisdictions it would target beyond Switzerland for offshore tax enforcement. But there are several crucial reasons why it would be much harder and less likely to succeed. Number one, Singapore already shares tax information with the US automatically on their tax information exchange agreement they signed with the US in 2018. Singapore also automatically shares banking information with China as well. Since 2018, Singapore has been sharing financial account information with China under something called the Common Reporting Standard. So if you're thinking Singapore offers some kind of banking secrecy from major governments, that's not true. Both American and Chinese tax authorities can see your Singapore bank balances, your investment income, and even your asset sales. Now, this raises an obvious question. If there is no real banking privacy, why would anyone use Singapore? Here's the thing. The ultra-wealthy aren't using Singapore primarily to evade taxes anymore. The whole industry has shifted. It's not about hiding money from tax authorities. It's about legal tax optimization and asset protection. But there's another reason why Singapore has a massive advantage that Switzerland never had. Singapore is strategically indispensable to both the United States and China. Since 1990, Singapore has hosted US military facilities. Right now, the country houses over 800 US military personnel and 15 different military commands. But here's the genius part. Singapore simultaneously works with China. Chinese warships dock in Singapore too. The two countries join military exercises. China is Singapore's largest trading partner, while US is Singapore's largest source of foreign investment. Neither the United States nor China can afford to destroy Singapore's financial system without shooting themselves in the foot. Singapore sits at the center of the world's most dynamic economic region. It's literally the place where US and Chinese interests meet. Singapore hosts the annual Shangri-La Dialogue, where both countries send their top defense officials. So, what does all this mean? Singapore has undeniably cracked the code. They've created the perfect storm of conditions to attract the world's ultra-wealthy, and they've built multiple layers of protection to withstand pressure from global superpowers. The billionaire migration will continue, bringing jobs and economic growth. But it's also creating profound social and cultural tensions in a country that has always prized on national identity and social cohesion above everything else. In many ways, Singapore's story is a preview of our collective future. As wealth becomes increasingly mobile and countries compete for global capital, we're all going to face the same fundamental questions. How do you capture the economic benefits of attracting the ultra-rich without losing your soul as a society? How do you stay competitive in the global wealth game while ensuring your own people aren't left behind? If you found this video insightful and learned something new, hit subscribe so we know there's an audience out there who wants more of these deep dive explainers. Thanks for watching, and as always, stay curious.